Well, hello, everyone. My name is Rhett Buttle. I am so pleased to be able to be the person who has the privilege of producing the economic content at the Aspen Ideas Festival. And the reason I'm so proud to be able to be part of this institution is because conversations like the one that we're going to have today, where we can bring together leading business leaders and policymakers to talk about the future of our economy. So with that, we have an amazing panel. We're so excited to have all of you. And it's my pleasure to introduce Zanny, who's the editor-in-chief of The Economist. Zanny, over to you.
Thank you. Thank you. It's great to be here. I've been to the Ideas Festival once before, and I'm thrilled to be here again. This is fantastic. I mean, particularly coming from overheated New York, where I was yesterday. This is just delightful. So welcome, everybody. This panel, for those of you who have looked at your program, has a fantastic title: Signals, Shocks, Shifts, and the State of the Economy. So it's part tongue twister, part pleasing alliteration to a journalist. But actually also, I think, very apposite, shocks and shifts. We are, I think, at the moment, in almost what is almost certainly the most shock-laden and shift-laden period of my adult lifetime. There are at least, I think, 3 huge shocks coming, or we are in the midst of, which will be, several chapters in our grandchildren's history books. The first one is the geopolitical shock. And this is not a panel on geopolitics, so I don't need to elaborate, but we are in a very different geopolitical world. The second is the economic policy shock. We are also in a very different economic policy world. Even though the tariffs have not been implemented yet, we are in a different kind of environment than we were a few months ago. And finally, we're in the midst of the biggest economic or technology shock since at least the Industrial Revolution in terms of AI. And if you put geopolitics, economics, and AI together, they have one thing in common, which is that the epicenter of those shocks is the United States. It's the source of the policy shocks, it's the source of some of the geopolitical shifts, and it's also ground zero for where the AI revolution has gone furthest and fastest. So that's the backdrop for understanding what is going on in the US economy. And why does it matter? Well, it's obviously your economy, for those of you who are American here. It's the world's most important, so it matters enormously to the rest of us. The US dollar is the world's dominant currency. US financial markets dominate the globe. So not just everyone in this country, but frankly, everybody in the world is affected by how the US economy performs. So that is what we are going to talk about. And we could not have a better panel to do this. And I'm going to go very briefly from your right forward. So Charles Scharf, you all know, President and CEO of Wells Fargo, the man who has turned around his bank. And it has now had its regulatory cap lifted. Congratulations.
Thank you.
Brian Kemp, the 83rd governor of the state of Georgia, a leading figure in Republican politics. Welcome.
Thank you. Thank you.
Lynn Martin, president of the New York Stock Exchange Group, which includes the world's largest stock exchange, and many others. Congratulations and welcome. And Larry Fink, man of these parts occasionally, and I think the man who has, what is it, $11.6 trillion and counting under management. That's a lot of money. The world's largest asset manager. So welcome to all of you. I thought we'd start, and we're going to talk for about 35, 40 minutes, and then I really want to make sure there is time for questions from all of you too. But I want to start by sort of what the military types call a sit-rep, a situation report on the US economy, which is like what sort of state do you think it is in? And Charlie, if I may, I'm going to start with you, because you see from your corporate customers, you see from your clients, because just 2 months ago, after Liberation Day, I think the general consensus was the US was heading fast for recession. And now I've come here and I sense that there's been a sort of turnaround in this. And although it's slowing, not clear that the recession fears are as strong as they were. And I learned, when I used to write about the United States economy, I always learned, never ever bet against the US consumer. Every time I said the US consumer was going to slow down, I was wrong. And I'm wondering whether that may be the case again. But Charlie, what's your take?
Well, I think the question really is going to ultimately be, what is the conclusion of the whole tariff situation? So when Liberation Day comes, tariffs get announced. If the tariffs continue to go forward as originally announced, it would have material impact on the US economy and on the consumer. And you saw that play through a little bit in terms of the psyche and in terms of the confidence levels that people have. But ultimately, what we find when we talk to our customers, whether it's consumers or businesses, is they look at exactly what's happening. They look at what they're seeing coming in and going out. And the reality is that there's still a consistent level of strength across consumers and businesses. Our customers on the consumer side, when we look at credit card spend, debit card spend, things going through bank accounts, it's roughly the same on a year-over-year basis as it was a week ago, a month ago, 3 months ago, 6 months ago. There's growth. It's not huge growth, but we're seeing credit card growth of 3 to 4%, debit card spend growth of a couple of percent, weaknesses in certain industries such as travel and lodging, but it's being made up for in other industries. And so overall, kind of week after week, we keep expecting to see some kind of change based upon what you read about in terms of confidence, but it's just not coming through. That then filters through credit. Credit is still exceptionally strong. Payment rates on loan types are extremely high. And then when you go talk to our commercial banking customers, which are not the large corporates which we all read about and know about, but the customers that have 20, 30, 40, $50 million of revenues, up to $1 billion or so, who supply the larger companies, they feel okay. They feel nervous. They're waiting to see, but they're actually more optimistic about the benefits that they could get out of the changes in trade, and they're willing to give it some time.
They're more optimistic about the benefits they could get out of the changes.
Yeah, I've been completely surprised. I go around the country, and everywhere I go, I do breakfast, lunches, or dinners with commercial banking customers. And I was even in California a couple of weeks ago, where you expect to, just get, the assault on the Republican Party. And what you get is, listen, trade has been extraordinarily unfair. We've had to compete with people coming into our market without barriers. We have huge barriers on what it takes to distribute what we do outside this country. So we're willing to take this period of uncertainty if we wind up in a better place. And there are 10% tariffs, and if 10% is the answer, we can deal with that. And that doesn't
That's really interesting. And I'm going to come to the financial markets in just a second. But Governor, first to you. What's your perception in the state of Georgia, and then more broadly about where we are at this moment?
Well, I feel really a lot the same way Charlie does. I'm very optimistic about things. When you talked about the shock, I mean, everybody, I think, was shocked initially with how broad and booming the tariffs were. But now that that's all kind of settled down and you're seeing how the president's playing this and how people are reacting to it, and it's like, all right, we were all worried and nervous at first, but now we got to figure out how we're going to deal with this. And people are starting to deal with it. And if you're out there, I really come from this. I've been a small business owner for almost 40 years now. Marty Kemp has too. Our daughter just bought a small retail business 2 years ago. On the consumer spending side, I have 3 daughters. I can tell you, they are very optimistic about the economy. And our daughter's business, I mean, she's struggling through like a new entrepreneur, but she's doing good. People I'm talking to in our state are very optimistic. Now, we do have certain projects we've worked on that are Canadian companies, Italian companies, some of our automobile manufacturers that are concerned about how the tariffs are driving the cost of the capital investments that they're doing to build in onshore U.S. manufacturing in the state of Georgia. And we're certainly passing that on to the administration. But people are figuring out ways to work around those kind of things. And I had a business person the other day said, I don't really like the 10% tariff, but like if we end up and that's what we got, we can deal with that. And I do think you're seeing the president now, whether you like this, whether you like him, whether you like the policy and how he's playing this, he is starting to get deals cut. It's just like the UK the other day announced that we're going to buy 12 new F-35As. Which is great for Lockheed Martin, and we're seeing a lot of those type things in Georgia. Our port growth, which to me I thought our ports are going to slow down because of containers coming from China, but we're holding our own there. We're very diverse. We're not like LA and Long Beach. You go through the Atlanta airport, it is jam packed. You're on our roadways, it's jam packed, and people are just. you know, at least in the state of Georgia, are just plowing right through this. So I'm optimistic as long as they continue to get people to the table and get deals, and this doesn't go on forever. And you know, literally right before we got on stage, Trump saying, well, you know, we may delay the July 9th tariffs again for a little while. So, I mean, I think they're just going to keep playing this thing out to get deals done. And, you know, there's a lot of opportunity out there.
So we can talk about tariffs a bit more later, but do you think, just briefly, the assumption that people in your business, people in your state are making is that this will get extended, that this is like a negotiating tool, it is not a big shift, and it's going to be 10%, not 30, 40, 50%?
Well, I think the thing that is a small business person, myself, and somebody that's in the government, I mean, business people want certainty. They just want to know what the rules are. I think not knowing that right now is what really early on gave people a lot of unease. I think now they're seeing that this is going to just play out over time, and we're going to figure out how to deal with it, and eventually they're going to come up with something that we can all live with. I mean, I would say right now in Georgia, we have winners from the tariffs like they are. I mean, we have people that make steel. We have the first copper smelting plant in the U.S. in probably 30 or 40 years. They're killing it right now. We have other projects where it's probably hurting. But we're also benefiting from good state policy, so we have a lot of people moving to the state. We had 3 record years of economic development coming out of COVID. We have the newest and most clean energy in the United States of America. So, you know, we're kind of
it's a great state of Georgia.
Second in line and growing on the data center war right now to Virginia, because we have space and we have power, and they're starting to run out of that.
So it's okay. Let's hear about the financial market perspective, and Lynn, let's hear from you. Clearly, if you look at what's been happening to the markets, they also seem to be now feeling much more optimistic. What's your take of what they are seeing in the U.S. economy?
So I think this moment in time, this last quarter, particularly the last 2 months, has really shown the resilience of the U.S. market, the depth and breadth of the U.S. market, the depth and breadth of the investor base in the U.S. market. I mean, if someone had said to me that first week and a half in April, before the pause was announced, that I would be sitting on a panel at the end of June with the S&P back at an all-time high, I would have laughed at them. But where are we today? The S&P is just shy, like a point or two of an all-time high. And we're seeing growth across industries. I think it just shows the resilience of the U.S. economy and the fact that the U.S. is an extraordinarily desirable place to do business. I was just in Europe 2 weeks ago, and while there was a pause around Liberation Day about companies looking to move their listings out of European markets, that conversation has now accelerated again. We just welcomed a company on Monday that was a Swiss-based company. Their U.S. business moved on Monday. So again, it's because of the valuations, it's because of the breadth, it's because of the depth of the markets. I think there is the other interesting dynamic that is occurring in the wake of the tariff discussion. You know, it could have been an opportunity, it could be an opportunity still for non-U.S. economies to look at, okay, well, how do we attract those large companies to raise capital in our home markets? But on top of the tariff discussion, you also saw this regulation rationalization dialogue starting to come out of DC, making it easier for companies to be public, for companies to go public, which has had a very positive effect on, finally, the IPO markets. If I look at the capital raised at NYSE through the first half of the year, it's up 50% from where it was the first half of last year. And we've got a large queue of companies that are making plans to go starting in the summer because of the way those post-Liberation Day IPOs have performed, particularly like a Circle or a Hinge Health or a Voyager Technologies across a variety of industries.
So that's the kind of deregulatory agenda that actually drove quite a lot of the run-up in stocks after the election happening. I have to say, listening to you say that the interest in Europe lasted a couple of months. I have mixed feelings about hearing. I mean, you're right. There was a moment where we thought, okay, finally Europe's moment has come. And I already feel it ebbing, slipping away from us in Europe. Larry, listening to these three, first of all, give me your assessment, but secondly, there are two, and they're not mutually exclusive explanations for what's going on. One is the resilience, the really deep resilience of the US economy. But the other is that, as you say, the president hasn't followed through. He has put these tariffs on pause, and that the well-known taco trade may actually be true. Trump always chickens out. That, is this that actually it's a bet on the most crazy policies not happening?
Well, if you go back, well, first, hi, Aspen.
You sound like a rock star.
Yeah. If you go back to 6 months ago to Davos, when everybody was talking about U.S. exceptionalism, and they were all shorting Europe. And then obviously we had a Liberation Day, and everybody started saying, the U.S. exceptionalism is going away. Rule of law, all these other issues that are being presented. But the reality is, the reasons why we loved the United States economy in December and January exist today. And that the markets are starting to show that more and more. Lynn talked about the stock exchange. But the reality is the U.S. has the largest, most robust capital markets. And this has allowed the United States economy to outpace Europe for 15 straight years. We are the envy of the world, that if you're a startup company with a good idea, you could get capital. The growth of the private markets in the capital markets is so large that if you have a good idea, you could get money. So small and medium businesses can get access to capital through the banking system. We have the strongest banking system in the world, and we have the strongest capital markets in the world. We are the envy of the world. As Annie talked about our technology position, that's actually getting stronger, not weaker in the last 6 months. And then, as you framed out, the U.S. consumer, no economy has more resiliency in terms of the consumption. And that is based on, despite all the noise and the negatives, still today, there's not an economy that is more hopeful than any other place in the world. Now, much of it has to do with we have not had world wars on our soil. And if you systematically look at Europe over the, they have been, their psyche has been embedded because of 2 world wars. And they cannot get out of that psyche. They save a lot more money than the United States. The average European saves 18%. And we save probably 5%, but we invest in equities, we invest in other things, we grow our businesses and all that stuff. And I think this is one of the fundamental differences, and I don't believe that optimism is going away. And yes, there are inequalities, there's big issues that we have to be addressing. I wrote an editorial a couple of weeks ago about globalization 2.0. And 2.0, we need to find ways to broaden the economic success. So, the globalization 1.0 has been powerfully successful. More human beings have been lifted up in the world than any economic period in humanity's lifetime. That doesn't mean segments of society have not been left behind, and that is absolutely true. So we're going to continue to be strong. But that being said, we are going to start seeing the impact of tariffs. We are going to have elevated inflation. And that's going to start coming out in the 3rd and 4th quarter. Auto companies are going to start passing on their added costs, their steel, aluminum costs, the cost of magnets, which was, we have supply chain problems because of Chinese make all the magnets. We are going to start seeing elevated inflation. The agriculture sector is having serious issues with labor, with the deportation issues. They're appealing to the administration right now. We do not have enough labor for the crops this summer. I've been told we're going to have supply chain issues, so we'll see if this all plays out. But and so all of this, and we're bringing back jobs, but the reality is we are at pretty much full employment, 4% unemployment. And the one thing I would just say, I'm very bullish on AI, but I wanted to say
we're going to come to AI.
But I wanted to say one thing related to the economy, because we are going to have 500,000 shortages of electricians in this country.
Yeah. Okay,
We do
I'm
not
gonna
have
stop you
enough.
right there.
Okay,
Because
I'll stop there.
I was actually no.
Zanny.
Okay, very briefly. I want to.
Yeah, I just want to add one thing, which is when we think about, you asked about what we're seeing in terms of our customers. The one thing there is there is a very big disconnect between what the market is concluding that they're gonna do and see versus what they're actually doing and seeing.
Yeah.
So consumers are spending, businesses are willing to give this a period of time, but when you dig down into it, they're not growing inventories, they're not investing, they're not hiring people, and they're drawing up plans on what they have to do in case things get worse. So they're giving the administration the benefit of the doubt, but there is a lot more concern that they have than exists in the market today.
Okay, so this is really interesting because for a moment I thought I'd landed on Planet Pollyanna, but now I think you are getting both. Larry and now you have finally saying that there is not all absolutely brilliant. And I feel sort of incumbent that I have to be the Grinch from Europe. And let's move.
But you are.
I know. But there are challenges. Yes, the U.S. consumer is incredibly resilient. I was a U.S. consumer for much of my adult life. I helped keep this economy resilient too. But even if not a single new tariff is put in place beyond the ones that have already been put in place, it is the biggest tariff shock since the 1930s.
Yes.
It is a 7-fold increase relative to where the US was. There is an immigration policy that may be what people voted for, but is a huge potential labor market shock to an economy, as you are saying, that is currently at full employment. You have a budget deficit that last year was 6.4% of GDP, and you have the brilliant, big, wonderful bill that is going to add even more to it. And it's peacetime and we're not in recession. I don't know. I don't think it's gringy to think that there are some risks in
Well, we didn't talk about that yet.
We're going to come to the risks. So now, with that, to provoke you, I hope, I want to ask you, what do you each think are the biggest risks that people... And we will come on to opportunities and upbeat stuff, but let's just sit about what are the risks right now. And Charlie, let's start with you.
Well, I think it's just what I just said, is that there's this view that it's all going to be okay, that it's all going to play out, whether Trump's going to chicken out or whether or not it's going to be just 10% tariffs, and whether or not we're going to get something in return, that he's not going to go through with something that's really significant on a country where it really could change the whole dynamics of supply chains. And it is quite possible that happens. The geopolitical issues, cyber response, there are a huge amount of risks that exist out there. But again, I just think, asking what the answer is going to be, none of us know. What we do know is that things are still strong, and there are more risks than there are opportunities to the upside right now in the medium term, even though over the longer term, the upside is still extraordinarily significant.
Well, let's go through some of those risks. And Governor, I want to ask you about the fiscal risk. As a long-standing leader of the Republican Party, the fiscal trajectory that this bill implies is a really, really worrying one. Can the US just carry on running these deficits kind of forevermore?
I would just ask if you were worried about how much money Joe Biden spent, even
I was as well.
post-COVID. So, and I'm not trying to take a shot at Joe Biden or the Democrats. I'm just saying you can't have it both ways. You can't be for his record spending that created literally 40-year high inflation, more spending than we've ever seen in the history of the country. The big, beautiful bill. Look, I think we need to do a lot more budget reform in Washington, D.C. But the thing that you're not talking about in there is what happens if they don't get the bill passed and they don't do the tax cuts. It is going to be a $2,500 per family tax increase. What will that do to consumer confidence? What will that do to consumer spending? And so they've got to come to the table and get something done to preserve the tax cuts. They're trying to rein in spending. The other side is howling at that. But if you really look at the spending that was done during the Great Recession that almost broke me as a small business person in 08, 09, and 10, and then you look at the amount of spending during COVID, and then you look at the time between those two things, the level of spending continued to go up. So there's never a correction. We cannot continue to spend in this country at levels that we are now. We've got to go back to a pre-COVID rate of spending maybe tied to the rate of inflation, and everybody's going to have to be able to deal with that. And you can't have states like California giving free health care to people that are not U.S. citizens and expect us to reset the budget. So, while there are issues with the big, beautiful bill, there are also a lot of good things in there that if you don't get passed, you're going to see the economy crash too.
So to be clear, I was not making a partisan point. I think there was a lot of reckless fiscal policy in the previous administration, and there is in this one. I'm just asking a bigger question, whether the United States, and it does have the dollar as the reserve currency, has lots of things that other countries don't have, whether it is okay to have a 6% of GDP budget deficit for the foreseeable future. And I want to ask the two markets experts here, because at some point, aren't global investors going to say, this treasury market is a little risky, we're going to demand significantly higher rates?
The fixed income markets is probably the area that I spend the most time thinking about in general, and the interplay between interest rates, the treasury market, and the geopolitical overlay that exists, particularly when you consider who owns the largest amounts of treasuries. It's not U.S. citizens. It's people that we are in the process of negotiating big, hard deals with. So the size of the debt is certainly an area of concern. I don't know if it should be 6% spending, 2% spending. I'm not smart enough. I haven't spent enough time in D.C. to go say it should be this exact number, but it is the market that in a lot of respects is going to be, I think, leading the equity markets. And I think that's what you saw in April, actually. You saw the debt markets leading the equity markets.
So Larry, are you seeing concern you manage money for everyone around the world. Are your non-US clients concerned about this? Are they concerned about the US Treasury market? Are they concerned about the role of the dollar?
So let's level set. I wanted to respond with the governor. After 223 years as a nation, our deficits were only $8 trillion. That was in 2000. And in 25 years, the deficits are now 36 trillion. Both parties are responsible. Government's responsible. And the pathway of deficits going forward right now, if we don't grow at 3% a year, will break the country. Will break the dollar. It's estimated by the Congressional Budget Office that the deficits by 2035, and I think they're wrong, I think they'll be higher, is $50 trillion. If we unlock growth to 3% through deregulation, through simplification, through permitting reform, if we unlock all this private capital that I talked about, the U.S. economy could grow at 3%, and the looming $50 trillion deficit is going to be manageable. If we can continue to grow at 2% or lower, we will hit the wall. It's just math. What does hitting the wall mean, as you framed the question, Zanny? It means we're going to have bond auctions that are going to spike up the interest rates. It would not be unreasonable to see that all the private sector will be crowded out because the public debt will be so large that access to the markets, all the things I talked about earlier, will be difficult. Small and medium businesses are going to have to be financing at 8, 9%. Mortgage rates are going to be at 8, 9, 10% again. These are the type of impacts if we cannot control the deficits. 20% of our deficits at this moment are financed by foreigners. That is the largest percent of any nation in the world that has foreign ownership to finance our deficits. Our debt to GDP is lower than Italy's or Japan's. Their debt to GDP is out of sight, 250%. But 90%, 98% of their deficit is financed by domestic savings. And so if we don't find ways of growing the economy, and this is what I've been telling this administration, how we need to unlock private capital, we're going to have a problem. And yes, foreigners incrementally have moved a little bit out of the dollar, but that's on a basis that they have been so systematically overweighted in the dollar. They're still overweighted in dollar-based assets. Most of our investors worldwide believe in the U.S. more than ever. But I would say one of the smartest investors told me one thing, and this gets back to one thing I said about inflation. So one of the smartest investors in the world is putting a big investment in one of the transactions we're working on. And in their analysis, they actually put a 2% systematic decline in the US dollar over a 10-year horizon. What it means is, more money leaving dollar-based assets. Now, I don't know if they're going to be right on that. They don't know if they're going to be right on it, but they're frightened enough that, they are overlaying an added risk that I never heard of. And if you overlay a 2% added risk to your investments, a lot of investments make no sense. And so this is one smart investor. This is not a trend, but it is an indication of one really smart investor with hundreds of billions of dollars is starting, as they continue to look at investments in the United States, they're adding a 2% overlay that the US dollar is going to weaken systematically 2% each year for 10 years.
Dollar risk.
Yeah.
Well, the irony, of course, is that I'm sure there are a lot of investments in the US that will still make sense, even with this overlay of dollar risk.
They're going to invest in this project, by the way.
So let's talk about precisely how you create that growth that you rightly say is essential to make the deficit sustainable and much else. And we mentioned the deregulatory agenda, that's part of it, but a huge part of it will come from whether and how effectively the US adopts artificial intelligence. It's clearly the transformative technology of our time. And because we're running somewhat short of time, the reason I want to talk about it is because it offers a huge potential to increase productivity, but it also will change jobs. It could eliminate huge swaths of jobs. It will change the nature of work, and it will thus have very big political consequences. So can we bring up any other good growth-enhancing things that you want to focus on? But let's talk about AI and how you see that being part of the solution or part of the reason to be optimistic about the US economy. Charlie, let's start with you.
Yeah, well, I think there's a lot of reasons to be optimistic. There's a lot of reasons to also worry about it. Because when we think about AI and what it takes to actually understand it well enough and implement it in your business to have the kind of impact you're talking about, there's a limited number of companies in this country that have the ability to do that in the same period of time. And so to me, one of the big fears that we have is how are we going to democratize the knowledge and the ability to implement the benefits that come from AI? Because there are a lot of great businesses that just don't have the resources, don't have the knowledge, aren't having the kinds of conversations. But if they were introduced to it and if they had some help, then they would certainly get there. And so when we think about the people we do business with from a business perspective, it's not something we've done much of yet, but it's certainly on my list of things that we've got to think about is not just for ourselves. I mean, we've got people working on things across every part of the company, every function, to become both more efficient, to provide better tools to our clients, all those types of things. Yes, it'll hopefully help with growth, it'll help with efficiency. Hopefully we'll be able to manage the productivity, which means ultimately having less people doing the same thing through attrition, work on retraining people, but it needs to get out to a broader set of people, and the ones we can impact are our clients.
Lynn, I'm going to come to you in a second, Governor, but Lynn, in one of the areas where this seems to be being adopted fastest is within the financial sector, and within financial market players. From what you've seen, how quickly do you think this is going to be a transformative force throughout the economy? Is it... Because it seems to me if it's as big a deal as people say it is, if it happens fast, this is going to be a really, really dramatic shock that could affect employment very, very fast. It could change the trajectory of the economy very fast. Do you think we're in that world?
I think we're headed to that world. I think people are recognizing, though, as opposed to just running at the opportunity, no holds barred, they're starting to take a step back in the financial markets, at least, and think about protection of data, particularly if you consider the potential poor effects of AI, which no one really wants to talk about, which is the cyber industry. So I think that there is no question that it's got transformative capabilities. We're starting to see it used in markets. I do think that the gating factors are going to be how fast we as a nation can go to provide resources that allow for the use of AI. In some respects, it kind of goes back to something Larry said, we're our own worst enemy on some of this stuff. If you think about energy permitting and pipelines and things of that nature, I mean, like, we have been in this regulatory morass for a long, long time, not blaming any one party. But now we run the risk of not having enough energy to fund that continuous evolution that's required, and potentially some poor nation states could fund that energy demand and have AI used as a weapon against us. So the cyber impact of AI is something that I think is causing at least folks in the financial sector to say, let me be thoughtful about how I roll this out, and as a first order effect, ensure that I am protecting my customers' data and defending it as vigorously as I possibly can.
So, Governor, I saw you nodding at that answer, the need for infrastructure, permitting, deregulation, and so forth. You mentioned earlier that your state was, second to Virginia in terms of data centers? Presumably that's going to require incredible increases in energy. And so first speak to that, how you see it changing your state. But secondly, I'm struck by the almost dissonance, this is within your party, but actually it's within both parties. On the one hand, the adoption of AI is going to be transformative and everyone wants to do it. On the other hand, there is a desire to put up tariffs to protect good middle-class jobs. Well, those are precisely the kind of jobs that are going to be hit if there is a very sharp shift towards AI. Talk me through how, as a political leader, you see that balance.
Well, I was shaking my head because I was just thinking, I was going to say, we have the energy and the power in Georgia to do exactly what Lynn's saying is needed with AI. We're ramping that up very quickly. Georgia Power also is working with our Public Service Commission right now to freeze ratepayer rates for the next 3 years. So as you see, other markets around the country recently have been raising rates. You're going to see frozen rates in Georgia for the next 3 years. We're ramping up. One of the few states in the country that can meet the need that's out there in the energy sector. And I think the AI, I have a lot of concerns like everybody does. How's this going to affect our children? How do we make sure we have guardrails without regulating too much? But I also am optimistic about the things that it could do. Just think about from the healthcare perspective. We are spending millions every year, even more money to train more nurses, more doctors. We cannot find enough mental health people, enough counselors. So you think about if digital solutions come to that field, if they can, help doctors write their reports, help nurses be more efficient, they're not getting burned out, they're not quitting. Same thing with teachers. It allows us to do more with the current people we have because we just don't have people to replace them with. On the, autonomous truck drivers, if the truck drivers lose their business, get knocked out of their job, we can retrain them to be all those electricians that Larry wants. So, I think we got to, seriously, we have to think about those kind of things. That's what we are doing in Georgia with our technical colleges and making sure that our university system and even our K through 12 and our CTAE programs are lined up with what our businesses' needs are. What employees do they need? Do they need engineers? Do they need nurses? Do they need, electricians or framers or whatever? So I think there's a lot of things that will be good that comes out of that with AI. We had last year visited 2 European companies that are moving operations that are part of building out the transportation network. They're currently in Georgia. They are increasing their operations to do more of that manufacturing in the state to help build the transmission lines and other things, transformers and other things that you're going to need to meet the needs of large electric users that we're getting in our state with those record investments and job creation that we've had, but also to help build out the network for Georgia Power and our electric membership corporation. So, I think as dicey as those things are, that we're seeing that onshoring back that will help to the growth that Larry is talking about. So I see great optimism in that. And look, we got to do something about debts and deficit and spending in this country, but it's going to take a time where both parties get together. And by y'all's reaction and mine, I don't think that time's right now. But there will be a time where there's a cliff that everybody's going to have to be forced to working together. But right now, for instance, just real quick, at the state level, we have to balance our budget in Georgia. We have done that. We have cut taxes, personal income tax, corporate tax, the last 3 years in a row. We have done $1 billion tax rebate 3 years in a row. We've given our taxpayers back $3 billion over the last 3 years, $500 cash per family to help them fight through high costs. We're making generational investment with one-time money that will serve us and our economy for decades into the future. So governments can do these kind of things. You just have to have a good business and regulatory environment to do that, and you have to make sound fiscal decisions. And there's going to be a point where the country's going to have to do that. I don't think that's going to happen right now, but there'll be a point where that is going to happen. You're going to have the same thing on workforce issues and other things.
But hopefully you have that happen before you actually hit the cliff. It's a little dangerous to wait until you've got to the edge of the cliff for that to happen. Larry, I wanted to round this up, and then I'm going to open up to some questions. You wrote a very interesting article in some newspaper called the Financial Times, I think, a couple of weeks ago. But it was
I would have been an economist.
No, it was a great piece, and it's a great newspaper. But the reason I want to end this round of conversations with you made the point that we're going to have more change in the next 7 years than one could even have thought of, and we were leaving the era of globalization without guardrails, that hadn't worked, and that we needed to come into a new era where we thought differently. And the reason I raise this now is because it seems to me that AI is the sort of the China shock of our era, in the sense that in the 1990s we had globalization, a whole bunch of jobs were lost, went to Mexico, went to China, and it dramatically changed the political view of trade in this country. AI may well have the exact same impact in terms of dramatic churn of jobs. What needs to happen now to ensure that you don't have the same backlash to this technology and we don't mess it up next time around, and we actually, as the governor said, equip people with what they need to thrive?
As I said earlier, we are the leading country in the world in the new technology, in AI. We need to be working with governments and with these companies and how to understand the trends that this is all going to create. Yes, we are going to see an enormous amount of job churn. So we're going to see a lot of jobs eliminated. But we're going to, as the governor said, truck drivers. That's probably in a long term a good thing, because we're going to, if you look at our birth rates, we are actually even sinking down our birth rates more. There's going to be need for more and different technologies, but in the meantime, we are going to create so many new jobs through AI, and the need in building out AI, as I said, 500,000 shortages of electricians and plumbers. An AI electrician makes over $150,000 a year. We're trying to bring back jobs in the auto industry. You don't make that in the auto industry. There are a lot of things that we could be focusing on, and that's why government needs to be working with these companies more than ever before. We have a huge, unique advantage. We are the cutting edge, and if we could find solutions together, I think we're going to have a happier, more hopeful place. And that doesn't mean we're not going to have churn and fear with these job changes, but I'm very hopeful if we can have that conversation together, we could create a more unified economy, a broadening of the economy. So it's not, yes, there's a lot of churn and change, but it can be churn and change for good. And just getting back to the power needs, the Energy Department of the United States government has estimated that data centers are going to go from 2% of our power grid to 8% in the next 5 years. That's over 100 gigawatts. We don't have that yet. And so, yes, Georgia has the power to do some of this, but let's be clear, we do not have the power in doing that today. Mm-hmm. And for those who are focusing on, sustainable power. We do not have the technology to do that cheaply yet, unless we're going to be dependent on Chinese batteries and all these other things. So we're going to have a pragmatic energy policy in doing this too. It's going to require a lot of gas, but at the same time, as we develop new technologies that transform the cost of renewable power too, then if that renewable power, like batteries, can be built here in the United States, we could have a really unique advantage. Just one last thing. I said we need to build 100 gigawatts of power. This year, China's building over 100 gigawatts of power right now, getting prepared for AI.
And if you don't build it, you're going to have a situation where people are going to be facing brownouts because the data centers need the power.
Real rising.
Let's get a couple of questions in. You have the microphone, so there's a lady here in the second row. If you could keep it brief, so we can just get a couple.
I'll be really fast. So as somebody who spends all day trying to connect government and small and big business and get to solutions, you listed the problems: labor constraints, energy constraints, permitting constraints. How do you do tech so it balances safety and innovation? And the governor's right. It's going to require nuance and expertise and compromise and hard discussions. How do we get back to a place where people want to learn and want to solve problems together? Because I don't think we can wait for the crisis.
That is a very good question. I'm going to take one more, because this can be your final wings when you come to answer that. One question over there. Yes. Gentleman there. Yeah, go for it.
Just a quick question. Mr. Fink, you mentioned falling birth rates. That's true in every major developed economy, including our own. Immigration's held us up. To get to your magic 3% line for growth here, how do we manage immigration in a way that can be accepted and maintained?
So that is also a very good question. I think we're going to start with that one and then because you raised a really important one. How do we get to work together to solutions? And I'd like all of you to come up with something concrete on that. Larry, first of all, can you perhaps start on the immigration issue?
Look, we have been the educator of the world. We have, I think, over 1 million foreign students in our universities. I think that's a good start to give everybody who has been vetted properly through our system that they're accorded an opportunity to become citizens here. If you look at the foundation of the United States during World War II or pre-World War II, we were the beacon of all these scientists in Europe who were running away. And that gave us the technology advantages. We need to be that beacon again. And I know that there's a lot of conversation related to the role of universities today. But let's be clear, there's a reason why a million foreigners wanted to have their children educated here in the United States. Let's take that and make that an advantage and use that as a backbone for positive immigration policy.
Okay, now you have literally 30 seconds each to come up with something concrete to answer this lady's excellent questions. How do we get to a world where people work together from both sides of the aisle, state, local, federal, to get some of these things done? Charlie, go in order.
Well, I mean, vote for candidates that are more centrist.
That's a great answer. Governor, 30 seconds.
I'm in the divine intervention camp. We need divine intervention.
Okay.
I do think, though, I know nobody wants to wait till we get to the cliff, but that's just what politicians do, at least federal politicians. So I think closer you get to the cliff, people will be forced to work together, and they will. On immigration, I think, the president's done an incredible job locking the southern border down. Yep. I think if he can get his bill done, everybody's going to get into the midterms. In the last 2 years of his administration, being an optimist, I think he is the one guy that could bring people together, Republicans and Democrats, to do immigration reform. And I know you laugh, but just wait and see. It possibly could happen. Maybe
I agree with the governor.
Okay, thank you.
But he listens. He listens to farmers. He listens to other people, and he's the first order Republicans always said. While you're working on, I said this at Davos 3 years ago. While you're working on immigration reform, lock the border down in the meantime, and then you can do that.
Very clear. 30 seconds, Lynn.
Mine was going to be very similar to Charlie's, but vote pro-business candidates.
Very clear.
Because you need business people who understand business issues and want to broker solutions and do deals in government.
Thank you. And Larry, you have 30 seconds.
We need to get candidates who are hopeful instead of chastising and creating divisions.
Hopeful, centrist, pro-business, and divine intervention. There we go.
I'll take
Thank you
that.
all very much.
Thanks, Governor.